Hello, trader friends. Welcome back to the Tom and Tony podcast, the better looking Tom and Tony. Hey, how are you, Tom? How's everything?
Doing fantastic. It's been an interesting month, but all is good here. So I know you've
Um,
been doing some interesting things as well. So hope things are good with you.
yeah, things I've been very busy. Besides trading, I last week I took a trip down to south of the border. We jumped over the wall with Tom Sosnoff, and that was a very fun trip. Tom had to give a keynote speech at a risk management conference in Latin America and Mexico, and that was very interesting. And so I went down with him to be his food taster, his caddy, his bodyguard. Well, I'm not a big, my body's not built to be a bodyguard, but but to be with him, hang out with him, and have some fun for the week. So it was a fun time.
Good. How's your golf game? How's his golf game doing?
So you won't believe this. So I played last year. I played 3 times. This year I've played 3 times. And Tom, I don't know if you knew this. He when he was younger, he used to caddy. I think he caddied for 7 years, and he used to be an unbelievable golfer. Of course, now we're older. We're not now no spring chickens anymore. So we on Friday we played 9 holes as a warm up, and Tom was hitting the ball pretty nicely. As you know, Mexico City is almost 12,000 feet above sea level, so higher than Denver. So the ball supposedly flies, much higher, much longer than at sea level. But there's one key to hit the ball longer. You have to hit it up in the air. when you hit those warm burners, the altitude doesn't help you very much. But it's more fun to play in the high altitude, and Tom played well. On Saturday when we played, Tom started par, and he played with one of my best buddies, John, who's an unbelievable player. And John started birdie. So right off the bat, they were kicking our butts. And but sooner or later, things started to normalize, and we had a good close match. And
Good.
I think Tom had 5 pars during the day, which is not bad for a course. And I was shocked. So I shot 44 on the front, which for not playing golf, I'm not mad at that. And then I shot a 40 on the back, and the 40 on the played Club de Golf Chapultepec, where they play the World Golf Championships, which is a tough course. The back nine is more difficult than the front nine. So I couldn't believe that I shot a 40 on the back. And so I was so stoked. I don't know. I started hitting the ball, Tom. I have no idea why, how, when I started hitting the ball. I mean, not like not incredible, but good enough to just
Sure.
keep the round going. So I was shocked to shoot an 84. And when I was younger, I was a 2-3 handicap. I'm telling you, like 100 years ago. But this is the best round I've had in three, I think, since COVID. So it was
Good.
fun.
Good. I think the best I ever was I think about a 6 handicap. So I was like a 5 or 6 in high school and college and played there. Then after that, I was playing for quite a while. And then when my kids were born, I stopped playing to start coaching like soccer, baseball, softball, all of these sports. So I couldn't golf as much, and my game just went downhill. So now I'm just out there trying to get by with a couple bogeys and a couple pars maybe in a round. But golf is so much like trading, because you're going to hit the ball enough good times to make you want to play the next week, and then you're going to have a ton of bad shots and think, why am I playing this stupid game? But then you're going to hit 2 good shots, and you're going to think, okay, I'm going to go play again next week. It's the same thing in trading. Is I'm going to win. Then I'm going to lose and think, I'm never going to trade that strategy, or I'm never going to trade again. Then you hit a couple winners. Okay, I'll keep going on it. But it's really all about consistency. So you just got to just keep at it, and it'll be all right.
You're absolutely right. I finished the round par, birdie, par, which I don't think I've had a birdie in 2 years. So, and you're right. After that feeling, I wanted to play a little bit more golf, and but trading has been the markets have been absolutely nuts. And I think before our last podcast, my account was at an all-time high. Your account was at an all-time high. I think I
100%.
remember
Yeah.
you were up almost 30% or like 30% for the
Yeah.
year,
Yep.
which was amazing. As you and I have different trading styles, and I was up, very nicely, averaging like 1.5%, 1.2% a month, and and but then this thing happened, and oh my God, did it get scary? It got really, really scary.
Yeah, it was certainly an interesting day and a half or so. I mean, that's such a short period of time. So it was a day and a half. Refer to it as Volmagedom. I mean, it was really just explosion in volatility triggered by the whole Japan carry trade piece. Rolled over, VIX spiked up. Went up. From 15 or 18 or something like that, all the way to 60. I mean, went up ridiculous amount in one day, and then the next day it was back down, and then a day or so later it was back to normal. I mean, it's crazy confluence of events. But as premium sellers, not exactly the best thing for our accounts to have something like that happen. And we were talking earlier, you and I, but while it's not really a black swan event, it is a black swan event. Black swan doesn't have to be a sell-off in the market. It can be any event that is a one-off or an unusual occurrence that can cause something to happen. And it's only VIX has never spiked like that, except maybe 3 times in history.
3 times in history. You're absolutely right.
So
3 times
trying
in
to
history.
plan for something that happens 3 times in the entire history of the market is pretty difficult. You just got to hope that you can manage your way through it correctly. Take some losses. Use your plan the best that you can. You get out, and then we're back at it again.
Definitely. And you know a little bit how I think. In order for our strategies to work, in order to be able to make money by selling volatility and being short Vega, these type of occurrences have to happen and will happen. Because if they would never happen, then the computers and the formulas will price the options much differently. So even though it's horrible when it happens, and I'm sure it will happen again during our lifetimes, it's probably, and maybe more often now than before, because black swans, before they used to write books about them, and now it seems we get a black swan every 4 or 5 years instead of every 15 to 20 years. So now black swans are happening more often than not. But those events actually make our strategy of selling Vega, selling volatility, and collecting premium, it validates them, because if that's why the other strategies work. The key to having, I think, these events is being able to survive them and not have your account shut down, and keep going. Because people who give up, I don't know if I told you this, that after COVID, when I had a big loss, when VIX was 88, and I had this short 28 SPX puts, and I think I told you on the last post, I was losing $100,000 per hour, not per day. And I do wanted to give up trading, and but I try to keep my calm, and I never give up. And thank God, if you keep going and keep doing things correctly, we can come back. Golfers have double bogeys and triple bogeys, and that doesn't mean you cannot win the Masters anymore because you had a triple or a quadruple bogey. You just have to keep going. You only lose if you give up, right?
100%. And I think this is where most traders really struggle. It's consistency. And consistency means you just got to keep trading. Okay. The whole trade small, trade often thing is as well. But you just got to keep, I think it's trade small, okay, which means you're sized appropriately. Trade often, which means consistently putting those trades on. And then also the last piece of that for me is trade with consistent size
Right.
all the time, because what'll really get you is, okay, I'm in trading, I'm taking in $1,000, $1,000. Now I'm going to size up and start taking in $2,000, and now I take a loss, and that $2,000 at a 2x loss, now it's a $4,000 loss, and it wipes out a ton because I was trading bigger than I used to.
Right.
So you just got to trade the same. You got to be consistent on your trade. But I think, I put out videos on this before, but I think chasing the shiny object is also dangerous. So you got to be consistent, and you can't be chasing the shiny object. You can't be, I guarantee what happened is there's a lot of people, some are trading 111s, 112s, 11965 stores, whatever it is. It doesn't really matter. If people are trading naked puts, trading SPY, trading whatever. Everybody that was short naked anythings had a bad day or so.
Yeah.
Some people will never trade that strategy again, even though it won for the last 5 years. They had, they've made, they've gone from a $100,000 account to a $500,000 account in the last 5 years. And now they lost 20% of it. And it went from $500,000 to $400,000 account. Oh, I'm not doing this thing ever again. Well, look, you made $400,000 the last 5 years doing this.
Right.
One bad day, you got knocked down, sucks. But then you got to get back on it. I'm not going to scrap a strategy that's worked for me for years and years and years and years and years. What I will do is we'll learn from it, and we'll improve what we did. And the biggest thing for me was it wasn't the 112 trade that got me into any trouble. Yes, did they perform great? No, they went down. But I did have hedges on, and we talked about some hedging. I think that right before that event,
we did.
I did have hedges on, and technically the hedges covered 2/3 of my loss.
Wow.
So on the 112 strategy that I was doing, what they didn't cover was I was experimenting with another 112 strategy, and I had 4 of those trades on, and I got clobbered on all of them. So I was trying to find a different style trade setup, and I was experimenting here, and those I wasn't really hedged on. My normal portfolio was hedged. It could have been better. Absolutely. Could have had a much better hedge. What I didn't do, and you've always made the point of, it's all about the quantity of naked puts. Well, I just had too many. I had too many trades on, even though I was buying power. Okay. I had too many naked puts because I had other trades on that were spec trades, not my normal strategy that I was experimenting with. So I was I wasn't double exposed, but I had a great deal of additional exposure at the wrong time there, because I would have probably unwound most of these or let them just die off because I wasn't going to move to that style trade.
Right.
But before I could do that, market reached up and bit me and taught me a lesson of, hey, you gotta control your size, not just the size of each trade. You can't have too many of the same style trades on. You can't be that short of naked. So I've modified a little bit of what I'm doing, and we're back up. We've made about, I should say I've not made necessarily, but I've recovered over $80,000 of the loss. This is a significant amount since that day in the last 4 weeks. Most of that is because I didn't unload everything, because I had hedges and had other things on. So it's something you learn. We get a little bit better. The next thing that happens, we'll get a little bit better each time, and then we come up with something that maybe helps us along the way. But I'm not scrapping anything, because that stuff has paid off for years. And just one event that's going to happen every 20 or 30 years isn't going to deter me from that.
Definitely. So, I read the comments on our podcast, and one of the things they love about you and I chatting together is how the takeaways that we give the viewers on our podcast. So for that horrible Monday, on Friday, Monday, what are your top 3 takeaways? And maybe we can dig deep into each one of them of what did you learn, and what are you changing on your trading style on those top 2-3 takeaways, Tom?
So I think the biggest takeaway for me was just too many puts. So just too many numbers wise. Vega was pretty negative, but I just had too many trades on at the time. So I had too many trades. It wasn't the fact that it was a 111, 112, 116. Doesn't really matter. I just had too many trades on that were susceptible to a big spike in Vegas. So I've corrected that. We can talk more about that. But
Yes.
number one was I just had too many
many
similar
units.
style trades on.
Okay.
So
Do you
too
think
many
having the similar strategy hurts, or just the units of those strategies?
I think both. I mean, it did both, because I had my normal long-term 1-1-2 trade, which has been my bread and butter for years and
Yeah.
years and years.
Yeah.
I had those on, and I did have those hedged for the most part. The problem is I had also started working with these XL 1-1-2 trades on, and I'd only been doing them for maybe 3 months, so I had like 3 or 4 of these things on, and the problem was the size was the same.
Right.
So I basically had double the size that I normally would have in this trade, and just too many naked puts. Just the quantity of naked puts was too much. So I think that was lesson one. Was, experimenting is fine, but I got to keep the size,
And
proper.
what's the difference between the XL 112 and the long-term 112?
So the difference was the XL trade is 150 DTE trade versus 120. So I was experimenting with what would happen if I do a longer term trade.
Okay.
I get a little bit farther away.
Yep. Yep.
You know,
More conservative, supposedly.
On it, conservative, but I still have the same number of naked puts, which I learned was maybe, again, like you say, it's not necessarily how far away you are. If volatility strikes, it's how many of those you have on. But I also was going more 100. I was really going around 200 wide on the put instead of 50. So it was a great idea that, hey, I'm paying for a 200 wide put debit spread,
right,
and still making money by going out 30 more days. Now I have this giant fat put debit spread that, hey, if when these trades come off at 90% or something on the naked puts, I'm going to be sitting on these big, juicy 200 wide put debit spreads,
right,
which is going to pay off if the market starts to sell. So the theory was great on it. And the problem was I shouldn't have been doing both trades. I should have either been in the XL 112 or the long-term 112. Either one I would have been fine. The fact is I was doing both at the same time because I wanted to see how this thing would react. And those are the ones I ended up closing. All of those long XL 112s, that's what I ended up closing. Long-term 112s, I only closed, I think, 2 of those.
And were you collecting the same amount of credit for the XL 112s than the long-term?
It was pretty close to the same amount of credit, maybe a little bit, just a little bit more credit, because
what do you collect, like $15, $20, or how much do you collect?
Yeah, I would say about $15 to $20. I'd have to go back and pull them up, but yeah, I'd say on average. In fact, I can probably give you a sense while we're talking, but I think about $15 to $20. I still have some on, believe it or not. Actually, I was around $12.
Yep.
Yeah. So actually, I was around $12 on these. So it was good because the margin's lower. So your buying power is lower on it, because the farther out in time you go, the less buying power you're using for those nakeds.
Right.
So I could actually take them down a bit. I mean, I think in theory the trade's good. You just can't do them both at the same time. It's just too much exposure. The other thing that so I think that was the biggest thing was, all right, you can't have so many naked puts on, and you just got to watch that volatility exposure. I have since moved back towards more of a 1-1-1 trade.
Right.
And taking my Vega in half, I'm still creating the same income. And what I've done is I've actually taken the put debit spread and I've moved it down delta wise.
Yeah.
So it's not costing me as much. So I'm a little bit less credit for the naked put because it's only one. Okay. But in order to make up for that, because I still want to generate the income, I moved the put debit spread, down a bit delta wise. And so I'm generating roughly the same income now with half of the risk.
Yeah. I think we've talked about it before. So you have the put spread here, right? And it's very rare. Well, I've never nailed a trap trade. Never. You have, not me, but so to me, if we have the debit spread here, right? We're here, And then let me see. Can you see my finger? So
Yeah.
if we can sell two puts here, right? I don't know if you can see my two fingers here, two puts here, or one put closer. If we're never going to reach this level, like if we're never going to reach the 20-yard line, I prefer to have one put at the 5-yard line than two puts at the goal line. So, for me, it's so rare to reach the trap that because so I'd rather have one instead of two. And I think you already saw that and the benefits of having just one, right? For the same credit. Of course, it's riskier because you are closer. Your nakeds are closer to the money, but since it's very rare, if we're going down, the one put on the two puts, they're both going to get slammed.
Right.
Right.
You're still having a problem. So I'm doing that, but I would say
Right.
there's a large amount of the members in our Discord that are still just doing the 1-1-2.
Right. And there's nothing
if you're
wrong with that.
hedged properly,
Yes.
it's a good trade. It generates cash. So most, I don't know about most, but a good majority of them are not switching at all to like a 1-1-1.
Right.
They're staying with a 1-1-2 because there's really nothing wrong with it.
Nothing wrong with
And
it.
what
Yeah.
I've done on the put debit spread is I'm using a little bit more technical analysis, which I know is never maybe it's a bad word and
No, I like
tasty
technical
land
analysis.
sometimes,
I
but
like it. I like it.
I just want to get some sense of direction. I'm not going to get minute on these things, but let's say the market's rolling over, and we'll talk about this maybe a little
Right.
bit. If the market's rolling over or starting to head lower, then you move the put debit spread up and you move that one naked put up a bit.
Yep.
So now you have a better chance of getting into the trap, and you might have to move your naked put up, or maybe not, because if volatility is increasing, you might not have to move that naked put at all. If the market's moving down and vol is increasing, you might still be able to stay. I mean, I'm mirrored backwards, but I still might be able to stay around 5 delta, because as the market moves down, this 5 delta put is getting to be more and more expensive each time that I sell it. But on the other side, I've got the put debit spread piece up here.
Yep.
I'm going to move it up when the markets are a little bit bearish. I'm going to move it down and pay less for it when the market's bullish, because you're right, you don't hit it that often. And I've only really hit it back in 2022 a bunch. Most of the time, it doesn't even help you.
No.
In fact, I know there's a good handful of people probably not just trading naked puts, instead of not even doing that, just trade the naked put and buy a put debit spread if the market starts to roll over.
Right. So I wanted to ask you two things. Number one is, so when I'm in a crisis mode, I want to see because you're only been able to use your instincts that day. You can't strategize, you can't think. So I wanted to ask you, because you're one of the best traders I've ever met. So during that day, how did you manage that day? Did you take the hedges off? Did you analyze to see if the put debit spreads were at full profit and take them off? I wanted to go through what stuff did your mind, because you're a very smart guy, a super great trader. Your results speak for themselves. I wanted to learn what instincts your brain gave you when there was no time to analyze anything.
Right. I think one of the dangerous things is the futures trade, 23 hours a day. Yep. I think if you were trading SPX or SPY, you might have done better, because by the next morning, people were getting in at night, or getting out at night on Sunday night. Futures was the bid ask was, so wide. You're talking like 100 wide on stuff. You couldn't get out without getting murdered, because there was no market. It wasn't a tasty trade or a toss thing. It was the fact that there was no market at night. It was not an orderly and efficient market. There was no market. So if you wanted out, you had to pay the piper to get out. And that's what really cost most people, was getting out at night. And why did they get out? Well, they got out because they were surpassing their 2x losses or what have you. But most people were getting out because their buying power had gone a bit upside down. So buying power expanded more, for a lot of people. So because of the expansion on buying power, it became a problem. And you had to get out, or they wanted to get out, and they were paying whatever they could pay to get out, and there was no market, so they were paying like way too much money. So for me, the most important thing was, okay, I just need to get my buying power under control a bit. So what do I need to stop out on? So the first things I start to take a look at is, what trades do I have on that are winning trades that I can close that will free up buying power, not losing trades.
Winning trades.
Because this is an abnormal thing, even though you're thinking it could continue. So you don't know that this thing's going to resolve, which it did quickly. It may, the market wasn't tanking, volatility was blowing up. So you're thinking, but you don't know what's going to happen. So you really got to be smart. But you're thinking, all right, volatility is crazy here. I can't get out. So let's get out of some of the winning trades to free up buying power. So I closed a couple winning trades, and then I had a couple strangles in some other. I mean, even oil was bad that night. So I took a loss on an oil trade. Okay, but I got out. Okay, so now I got my buying power back to like a reasonable level, and then I wasn't going to stay up all night and deal with this thing, because I'm like, I can sit here and make myself crazy and try to close the whole thing and get out, or I could wait to see if things normalize a tad. I just needed the bid asks to come back to normal, and it's just not a normal, market. I just needed. So the easiest thing to do was I bought a 5 DTE. I bought 5 DTE puts, long puts. They gave me buying power relief, and it let me go to sleep. Like if the market's if I'm going to wake up in the morning and the market just keeps going down, these are going to pay off. I'm going to make money on these. My account's going to stay exactly where it is for the most part. And if we wake up in the morning and things have not gotten worse, they get better, well, then I'll take a loss on this trade, but I'll still be in most of my other trades. So I think that was helpful. So my hedges had gone up. I put this additional hedge on, but I closed no hedges. And the reason I didn't close any hedges was the whole purpose to me for hedging is to recover losses. Well, I didn't stop out. I mean, I was stopping out of spec trades, and I probably could have closed my hedges, but my hedges were there for my long-term 112 trades, and my standard trades.
So that's a question that I had. When you put in a hedge, those 15, I don't remember what 15 days or whatever. Trade. When you put in that hedge, what is your plan? If we crash, you're going to take profits on the hedge, or the hedges allow you not to take the loss on the long-term 112s, or I want to get my head around the hedge. The hedge is good for what? For allowing you to not close the 112s, or to take profits, or what is the goal for
the only thing my hedges were for, and again, this was a delta hedge, more than anything. I was looking at the market dropping, not a volatility hedge. Okay. And I think you have two different hedges to start to look at these days. I think you need a delta hedge and a volatility hedge. Most delta hedges are volatility hedges as well. If market blows up, they're still going to pay. Okay. But the only reason they're there for me is to mitigate damage, which means only if I stop out of trades will I start to take hedges off, because they're there to pay for losses. Okay. Just because the trade is losing is not a reason for me to. I'm not putting on a hedge to make money. It's only there to pay. It's only there as insurance that if I get in an accident, and the trade crashes and I have to close it, well, now I have to take off some of the hedge. So let's say I have 6 trades on, and I have one hedge, and maybe I have, let's just say 6 contracts. We'll make it easy. Well, if I closed one at a loss, I might take one contract of the hedge off.
And that day, did you do that, or did you keep the hedges on? I'm just curious what happened that day. I don't know if you remember.
I didn't take any of the hedges off. The only hedge I took off was that one I bought the night before. Because that was up like 15 grand or something like that. So I took that off. But by the time I took it off, it had probably gone from 30 to 15 or something. So I didn't get a full benefit of
Full
it,
full
but
benefit. Yep.
the market had recovered the next
It's
day.
very hard to make a lot of money on the hedges. It's very hard to take them off at the correct time.
So I only take off a hedge if I actually close any trades for a loss.
Okay. Now I get it.
I
So
could
if
have
you take
closed them
if you
that
take
morning,
yeah,
but who knows what was going to happen the rest of the week. I could have closed them that morning for 50, 60 grand, and I would be 60 grand ahead of where I am right now. I'd only be down about 8% or something like that on it, mainly because I would have closed the hedge. But because I didn't close out of my trades, I didn't close my hedges. So if you close your trade, you close your hedge, because there's no reason for a hedge anymore.
Right. That's where I trade. You and I trade a little differently, because I don't try to make 2, 3, 4% a month. So to me, my hedge is the size, and my thinking. I don't stop out of my 111s or my 120s or anything. To the downside, I don't mind owning spies. So my hedge is the notional size of my trades. As long as I have capital to hold the spies or the SPXs, I will keep them on, because sooner or later, in my mind, is the market will bounce back. This one bounced too fast, but let's say it didn't bounce back too fast. In 1 year or 1 year time, the market will tend to go up again. So of course I make a lot less money than you trading, but I can hold them until they bounce back, because my buying power will still be okay. Of course, during normal times, you kick my butt, because I you make a lot more money every month than I do. But I don't have a lot of hair left, so
and that's the risk. And that's the risk of that's why we trade. I mean,
exactly.
if I wasn't doing that, it would be investing, and there's a difference. So
It is.
this is just a trading account. Yes, I have other accounts that I don't have this kind of risk on, and there's other accounts that I don't try for 2 or 3%. I'm only at 1.5% a month or something like that.
Yeah, which is what I try to do myself. Yeah,
1.2, 1.5% a month. That's fine. Yeah. Those held up pretty well for the most part. I don't think I was hedged enough on some of those, but I have another account that's a PM account that was naked puts and SPY, as well as some other types of trades. Didn't close anything, because you and I talked that night, briefly. And I mean, I think the one thing that you mentioned was, I'm not going to take a loss. I'm going to roll, and I'm just going to roll and until I can be right. I don't love rolling futures, but at SPY, I would have no problem rolling SPY. I mean, we weren't anywhere near the strike, so there was no reason to close it if I'm okay rolling.
Right.
So I'm not going to roll until we get close to the price, and then I'll consider rolling out, up or down, or just out. I don't need to go up or down early. I roll out in time and give myself another 30 or 60 days or 90 days or something. If I can grab a credit or no credit, I'm okay just rolling out. So the market will recover in a year,
2 years, 5 years, whatever. It will come back.
2 years, 3 years, something like that. The market will recover on those, and I'll keep trading and making money while these things, slowly recover anyway. So I think it all depends on what you're trading. And, for most people, it's just scary. So the quickest thing is just get out, because you're shell shocked. And because it's new to you. Now that you've seen this, would people do something different? Well, there's a lot of people that held and didn't do a thing. Some people slept through it. So, it is what it, exactly. And then the next day they were fine. They're like, well, what are you guys talking about? You're all stopped out happened? At 6X last night, and all my stuff's down like 1.5X. So, sometimes it was dumb luck, and some people held because they felt, we're so far away from the strikes, it's just a volatility thing. They got lucky because they didn't adhere to their plan, and you got lucky. The problem with that is the next time something happens and you ignore your plan and you don't get lucky. Meaning that, it kept going down. Now we go to 70 VIX on Tuesday, and then and then the market drops 500 points on Tuesday. Well, all those people that didn't stop out, well, now they have significant problems. Okay, now now it's margin call, city. Not that people didn't potentially get margin calls because of their
Sure.
buying power, but
Of
now
course.
you have a problem because you got lucky once, and because you got lucky once, you'll do it again and you'll ignore your plan. That's probably the most dangerous thing for many people listening.
That's a great thing you just said. You're absolutely right. Just to come clean, I was almost 8% on my account the day this happened, and my account went to exactly that Monday to 0% profit. So I lost all my profit of the year. I lost 8% that day,
Mm-hmm.
but I did not go negative, which is crazy. And I was happy
Great.
because finally, after being an old guy trading, I said, "Oh my God, being conservative right now, I'm okay." And going back to even, I was able to sell some puts that day, a little bit. Uh, it seems, oh, Tony, you traded great. No, because that's how I trade. I'm gonna make a little less, every month, and if the shit hits the fan, I'm gonna be able to
Sure.
sell some puts. So that's it's a different, it's like the guy who goes for the green in two, or the guy who hits a little iron down the middle. Of course, you on the long run, I think you're gonna make a lot more money than me trading. But on the times where we have a double bogey, I think I'm going to lose less. But that doesn't mean my strategy is correct
Right.
or your strategy is correct.
No.
They're two different styles. As long as you have
100%.
your plan and you know what to do when the shit hits the fan, then and you know how to protect yourself because you're a smart trader. You had hedges on, you had you knew where the strikes were and everything. And so that doesn't mean I'm correct or you're correct. It's just everybody has to trade their own risk tolerance, and trade the size that they are comfortable with, and there's no wrong or right way. The wrong way is to get cleaned out and lose all your account. That's the only,
Right.
and the only way that happens if is size is wrong. And size kills, and we've all learned that. I learned that during COVID, and some other people learned that Monday, and some other people learned that in 1989 or 87 or 2002 or 2008, depending how old you are. So we all learn the lesson, and the most
100%.
important thing is to learn from it, understand how you felt that day, and what makes you comfortable going forward. And I'm so proud of you. I was watching your video the next day and the next 2 days, how you came out of it. And I even told my wife, Tom's going to make a fortune during the rest of your life, because your attitude, Tom, your transparency, your intelligence, I just have to applaud what you did the next 2 days. And not every person would have done what you did, and I applaud you. As your friend, I'm very proud of you. I'm
Yeah,
very
appreciate
proud
it.
of how you
Appreciate
did
it.
it.
It's not fun. I don't don't love it. I got a good chance that I will be back to, I'm down for the year just slightly now.
Yep,
I got to, I certainly have 4 more months to go
of course.
in this year. If I just hit my plan, I'll probably be doggone close to break even.
Yep.
In this one account. I have other accounts there that I'm feel totally fine in, that are up for the year. So
Right.
I'm good with that. I've done some. So now, but one thing too is now you can't revenge trade either. So you can't
No.
go crazy. So I've tweaked the plan only a little bit. I just went from a 1-1-2 to a 1-1-1. That's all. I tweaked the size of the structure of the trade, but that's it. So I have half the naked puts that I used to have on.
And
Okay.
for the
And my
same
big
credit,
is way down. What's that?
normally, how much money do you collect for a 112? To remind the viewers, how much dollars? $1,000 for a 112, or
No, it's a little. It's more than that. I'll give
2,000?
you. I'll say I'll pull one up here and give you a good sense on it. But on the whole, for 112, it's probably in the neighborhood of. It was like $26 times three contracts. So what's that? $3,000, something like that.
Yep. That's on ES or SPX?
Yes.
Okay.
So on
Okay.
ES, I was collecting around $3,000. Okay,
Uh,
but I have a
yeah.
$500,000 account. So collecting about $3,000. A 2x loss would be a $6,000 loss. So I would be totally fine if I lost a bunch of those. So I'm still less than 2% on it.
Right.
But I
Mm-hmm.
think the thing here was I'm still collecting. Now my account's a little smaller than it was, so I'm not. I've sized appropriately for this, but I'm still collecting like $4,000
On the
per
111,
per
you're doing
111 now.
okay. So it's about, let's say it's the same
It's
dollars you're
basically would be
collecting,
the same.
same
Yeah.
dollars. So the only thing you did was to move the risk a little closer to the trap, but for the
I
same
moved the
credit.
trap a little closer to the. I've moved the trap down. I didn't
Oh,
touch. I did not go to like a 7 or 8 delta. I stuck around 5 or 6. I might be maybe 6 delta on the naked
okay.
puts now instead of 5. But I just paying less for the put debit spread because
Yep.
we're in a bullish market that I don't really need that as much. So I need the
Right.
income. And then to supplement that, now I've gone to a little bit more on the spec trade side. I've been doing a lot more put credit spreads.
Okay.
So I've been putting put credit spreads on still mostly on futures, copper and oil and
Yep.
gold and
Yep.
bonds and the
Yep.
10-year note and silver and the Aussie dollar. I'm still doing strangles,
Yep.
although I am having a really hard time finding anything good to trade right now.
Right
I,
now, it's,
I
it's very
I
hard.
don't like, you and I talked briefly via text, but
Yep.
I don't really like the market. It's
No.
a little lofty for me. Gold's
Very
a
hard.
little lofty.
Yep.
Oil's falling.
Yep.
Bonds are rising, but they're a little lofty.
Yep.
And then the Forex is all way up because the US dollar's way down. So the Aussie dollar's way up, the euro's way up. Nothing is kind of calm right now. So everything's in a little bit of a disarray. So I'm finding it, strangles is one of my bread and butter trades. And right now I'm having a heck of a time. I'm trying to put one on right now, but
Well, we had a little down
I've only
move
got
right
one
now.
strangle working. Normally I have 5.
Yeah. Yeah. It's not an easy market right now. Now, when you moved to the 111 from the 112s, did you reduce the number of money you were using for the hedges?
No,
No.
I kept this. I'm keeping the hedge the same. My hedge is based largely on a percentage of my account size.
Okay.
Um,
Okay.
So it might technically be a little bit less than it was, but for the most part, it's probably pretty similar. But I've added a second hedge. So I've never been a fan of the whole black swan hedge thing. And it's a free hedge. Well, it's not free because you're selling naked puts to pay for your long puts. So that's always been the thing. But it's a good Vega hedge, I
Yeah.
think is what it is. And I think the best Vega hedge to me is having a boatload of far out of the money puts quantities.
Yeah.
You
Yeah.
know,
Yeah.
and I know, you and I know, Bobby as well. And, he got beat up because he tried to start a hedge right before this thing and he shorted, I don't know how many, 20 or
Mhm.
30
You know,
naked puts to start paying for a long hedge.
I was in his podcast like 6 or 8 months before, and I got a lot of in trouble with his viewers because I told him that the size he was trading, he's gonna blow up his account, and I did the math and the notional and everything, and they and he's also a super smart guy, super smart
Yeah,
trader.
he's a great guy. I love
He's
Bobby.
a great guy, and then I think he had some black swan hedges on that helped him
He
survive.
did, but I think that hurt him. So because he had so many naked puts on, I'm not just saying it's Bobby, but a lot of people that had,
Right.
some people did well if they were mature black swan hedges.
Right.
But if they're immature, new black swan hedges, you're selling a lot of nakeds to pay for these far out of the money longs. And until you start to take off some of those nakeds and add more longs, if you're newer into it, you got beat up on this event because you're your nakeds that you were using to finance this whole machine
Right.
got killed, and
Definitely.
you lost. But I think there's some value in those. It's just finding the right one. There's a million of them. There's sell 3 by 5, sell 3 by 8, sell
Yeah.
3 by 5 plus another extra one, sell 5 by 10. I mean, there's a million different
Yeah.
things. I've come up with something one of our traders had shared. I took kind of that structure. I'm using that a little bit more as a volatility hedge. It's basically buying. I'm buying, they're selling, but I'm doing it a little differently. But I'm buying a out of the money put fly, and it doesn't get in trouble because I paid for it, so there is absolutely no downside to that.
Right. Right.
It's way out of the money, and what I'll do is those center strikes that I paid for, I will slowly unwind those center strikes and buy more long puts as I unwind it. So I'll have more puts over the long term than I will short. So anyway, credit one of our members for really kind of coming up with the basic strategy on that, and I like that. So I'm using that as a Vega hedge, and I'm sticking with my 14 DTE standard hedge, and I feel
Have
pretty
you
good.
ever considered not doing any hedging and taking that money that you use for hedging to reduce size? Since the hedge takes away profits, right?
Yeah.
What if you sacrifice some of the profits from the trades, not have the hedge, and just do a smaller size? Have you ever thought about that?
Yeah. And I think to an extent I am doing a little bit of that now with the 111. So I'm going to take in a little less income than I was before. And I probably, even though I'm still going to hedge a bit, I think my hedges are smaller. But I just still have something running. I think you can hedge on demand a little bit more when things go wrong. I think you have time in most sell-offs to start to put hedges on. So yes, I mean I think about it all the time. I've lost more money hedging than some people make in a year.
Yeah,
Like
that's
if
what
I
I was going to
didn't
ask
do it,
you. Yeah,
where would
exactly.
I be? I'd probably be ahead. Okay.
Right.
Yeah. Instead of having a $500,000 account, I'd probably have a $650,000 account, and I probably lost 150 of that. So I'd be right back to where I was. So it's probably a wash with all the money spent on hedging, but I think it helps you sleep at night. I think that's mentally an important part of the game. But I think you got to hedge if you're going to do these naked puts. I think you really should be hedging. I don't know that I can reduce size enough to make enough money to not hedge. But I like the fact that I have credit spreads running. I do some poor man covered calls stuff, zero DTE, not today with the market selling off. But for the most part, I do like those strategies. I'm not in them as long, and they're generating additional funds for me right now while I'm waiting for all of these new trades to start to come off. And they've been slow decaying for a couple weeks now.
Yeah. I saw your video about the poor man's cover call. I love it. And I do sometimes a little bit similar to that. I've been doing that for TLT for a year and a half ago.
Mm-hmm.
I've been buying even the 80 and the 85 strike on TLT because I think ultimately TLT was going to go higher. And I've been selling calls against that for almost a year and a half. And it's been working. And
I'm doing that. I'm doing that as well on TLT right now. I have the 97 that leaps. So I actually own the $97 leap. I know TLT is right at at 97.
Seriously,
but,
I own the 85 calls. Yeah.
And then I'm selling the 100 calls.
That's smart. Yeah, sooner or later, I think I will almost have my long TLT calls for free because I've been doing it I did them for a year and a half out. So I've been selling. I don't know what to ask you on the poor man's covered calls. Let's say I have 10 longs. I always under hedge. So when I have 10 longs, I sell 5, 6, 4. I never do 10 against 10 myself because if I'm already bullish, what I've learned is if I'm right directionally, I don't want to get killed on my on my on my on my covered calls, you know.
Right.
So I always sell a little bit less calls than the longs that I have.
So I have a different portfolio. The main trading portfolio, I'm very active. I have a high goal, 3%, 2.5%, 3% in there. But I have another portfolio that I run for members, which is a portfolio margin account, and there's
Yep.
no futures in that at all, and that
Okay.
held up well. And I sell SPY leaps every week in there, but I also have NTLT. I'm actually looking at it right now. I have a $75 call. So I bought $75 calls at 504 days out. Okay. And I'm writing calls against those. I also have I just bought XLE yesterday. So
Yeah.
I'm doing a poor man's covered call on XLE. I've got poor man's covered calls on SoundHound, which is a stock that is AI related.
Right.
MicroStrategy, which is a Bitcoin proxy.
I
I'm
love
doing the
Bitcoin.
same. I'm
Yeah.
doing the same on MicroStrategy. I have another one on IWM. So on the small caps, I'm doing poor man's covered call on small caps, and then on a stock called Clean Spark, which is a Bitcoin related to. I'm pretty bullish on Bitcoin. It's getting hit a little bit lately, but I like Bitcoin. So MicroStrategy, I'm doing this poor man covered calls on MicroStrategy, Clean Spark, SoundHound. Not SoundHound's not a Bitcoin related, but and Mara. So I put credit spreads on Mara.
Right. What I love about Bitcoin, I think it's the only asset right now that has the possibility of outside crazy returns. Bitcoin can go, of course, to 20,000, maybe 16,000. I don't know, but it can also go very soon to 200,000. And I don't have anything in my portfolio because I'm a boring old guy. I have TLT. I have SPY. I have SVXY, which I love. SVXY. It's like my core position, and it's one of my core positions in the portfolio. But Bitcoin is the only thing I have in my portfolio that could go down 60% or up 300 or 400%. So that's why I want to have a small part of my portfolio in Bitcoin. Yeah.
So I like Bitcoin right now. I think it's good. It's taking a little bit of a hit now, which I think is giving you an opportunity to trade it. So I like the poor man covered call. I think it's a great strategy. I do naked SPY puts, and then I do just a lot of credit spreads. And I don't do like short, mostly don't do short term. I like stuff that's around 75, 90 DTE, put credit spreads. I'm looking at a couple. I've been really successful on those, and I'm doing those, and even in the main trading account on some of the futures, like copper and gold and silver and some of the things like that, because it's helping me generate more wins while I wait for these 111s to come off and start to regenerate cash again. So in the meantime, I'm generating cash flow with these things. It's paying for hedges, okay, but it's also it's recovering my account quickly without really revenge trading and increasing size. I'm just finding other strategies that I like.
No, that's great. That's great. And oh my God. So what do you see, Tom, going forward to the end of the summer or the beginning of fall? What are you sensing right now in the market?
I just have this, we're still bullish when you look at the weekly chart. So things are still bullish, but it feels toppy to me, even though we're not technically overbought, using RSI or something like that. It just feels toppy. And I really think we need to pull back somewhere to the 50-day moving average or something like that. I think it's just healthy for the market. I think there's a lot of underlying currents out there. I don't want to fear monger and stuff, but I mean, this government is out of control. They're spending like drunken sailors.
They are.
So the debt is at some point this has to come back to roost. It's not going to be in the next week or two. Okay, I think most of that Japanese carry, the Japan yen carry trade, most of that's unwound. There's like 25% of that's left. Maybe there's still some things in there. I think oil's a wild card. I think recession in China and other areas, even if the
Yep.
U.S. is not heading into a recession, which still could be very likely next year. I think you've got some tough economies around the world, and if demand starts to fall, prices are going to start to skyrocket, and that's going to affect earnings. And I just think I'm very cautious right here, just being very cautious.
I think when you have a cockroach, like we had VIX hitting 60 in a day, and I think it was manipulated back up in my point of view, because normally when you have an event like that, to me, it's not a one-off. And so maybe they were able to patch the dam from breaking the next day or that same Monday. But once you have a big warning like that, it's like a canary in the coal mine, like they say. I think there's something else brewing. We don't get that Volmagedom, and then everything's back to normal. Everything's bullish trend. Everything. So I would err on being cautious right now. Especially we have elections in the U.S. We have
I think
China.
that's a big wild card. I mean, I
It's a
think
big
the
wild
election
card.
is I don't care who wins
No,
on it. I don't know that the market's going to love either one. So,
I'm not worried about the election. I'm worried about the days after the election, where the country is so divided that both sides are not going to be happy with the results, and I don't know what's going to happen. So that could create a little uncertainty until the inauguration, a little bit. Who knows? Maybe I'm wrong. And but anyways, when you have a vol spike like we did, I don't think it's a one-off, and we're back to everything's rosy. So I just would ask everybody out there to be careful, control your size, err on the side of being conservative a little bit more. And when you have opportunities, pounce on the opportunities. Don't be afraid to take the opportunities. And during that Monday where you said there were no bids, actually, I'm crazy that way. So do you remember that flash crash that we had like maybe 10, 12 years ago? So when I was younger, I used to watch Jim Cramer all the time, and he said to always have bids. So I had bids in my platform for AT&T, McDonald's, Microsoft. Really, I mean, crazy bids way down. And during that flash crash, maybe it was 10, 12 years ago, all of my bids were hit, and I was able to buy the stocks for really, really cheap prices. But what I didn't know is when things calmed down, the broker busted all my trades, and I didn't know they could do that. They said that was a glitch, that the bids were hit incorrectly, but I had the bids there for months. And when the thing flash crashed, I bought the stocks, and then they took them away from me. So I didn't like that very much. And but anyways, on that Monday,
did pounce on that Monday though. That Monday and Tuesday, I put trades back on. I was buying naked puts, rebuilding my 112s that day and the next day, with volatility being elevated. And some of those naked put trades that take wherever, some of those were coming off in like 5 days, 6 days. I mean,
exactly.
It was a great week if you took advantage of it.
Definitely. I put in some crazy bids, maybe 10 different ones with crazy bids, and I got hit on one only because maybe somebody got desperate and they hit on me.
That's why I don't typically, people ask me, well, do you set a stop loss in the platform? Like, I don't, because there's people that put in a bad bid somewhere, and I don't want my stuff called away early, even though it's a win or a loss or whatever. I don't want to take a stop loss because some guy put in a crazy bid. So that's you putting in those crazy bids that somebody's on the other end of that trade. So you got in at a great price. Somebody got out at a horrific price.
Yeah.
So that's why I don't like putting in some of those bids on the stop side. But yeah, totally. Yeah, makes sense on your side.
But it's fun. But I have a lot of stuff happen to me during the year, so it's going to be very interesting. You see, just while we're doing the podcast, the market was up a lot then it went down. I don't know if you noticed, went red,
Yeah, much. Yeah, a
and
bit.
now
Yeah.
it's back up again. And I mean, we're just like going nowhere, and going nowhere, trending up. That's the feeling that I have. I think sell-offs are not holding. Rallies are holding a little bit more, but having some resistance. So it's not an easy market right now. It's not an
No.
easy market, and
I think
mhm,
the swings are big. I mean, you're taking a typical day in the SPX, the expected moves like 20.
right.
Okay. I mean, so when we opened today at what, 56.10, or well, actually we closed yesterday around 5,600 or so,
Yep.
what have you. But, and we're right at 5,600 right now.
Yep.
But we ran up 30 points more than the
Yep.
expected move. Then we dropped all the way down to 55.80. So we
Yeah.
dropped 20 points.
60.
So we swung 50 points the other way. We were
Yep.
down 20 at one point, and now the day's flat. Well, I did a little zero DTE trade today. That didn't work out great because we had a big sell-off. Had I held on to it, I'd be out for a nice winner by now.
Right.
But these intraday swings right now, that's not great stuff to
It is
see.
not
You
great
don't
stuff.
want to be moving outside the expected moves that this often. That just means, like I said, there's some underlying, and VIX is still low. VIX is at 15, but we're outside the expected moves on a daily basis, and I even have a chart with just expected moves on it.
Right. And I
On the
want to give
SPX.
everybody some homework for Labor Day. We have a long weekend, and this is something I like to do when there's more time. So I encourage everybody to grab their watch list, maybe grab 100 symbols, all the indices, all the commodities, all the ETFs, the sector ETFs, and put a chart up, like a 30-year chart. And I like to do that sometimes. And then take a look at the ups and downs, and maybe mark off, although I'm not a technical person or anything, mark off some places where if we go down there, you were willing to buy, and if we break out to blue skies, you would also be willing to buy the new uptrend. So I love to look at really long term charts to see where things are going. And I think it's a very, grab a coffee, grab a glass of wine, whatever you like, a Diet Coke, some potato chips, and just look at charts for an hour and a half of everything, all the indices, all the commodities, all the crypto, and see where we have been and where we're going, and maybe find some targets and some prices that you're willing to take risk, because when it happens, your mind is it's moving too fast, and you won't be able to make calm decisions during that time.
And I think if you look at, and I was just looking at the expected move on SPX. This is the first week, although it's not over, but 3 hours left. This is the first week in the last 10 weeks that we didn't move outside or below the expected move for the week. So it's the first time in 10 weeks that we didn't have some, big expected moves. It was a relatively calm week. But I think if you look at the charts, like you're suggesting, the one thing that's going to stand out for you if you're looking is that we are not having new highs right now. This is, if you look at the weekly charts, there's almost nothing that has a higher high right now. Right now we have all lower highs and lower lows off of the high that we set back in the middle of July. We have not exceeded that, and pretty much on any stocks that are out there, and that's what makes me nervous.
No, so it's time to have a nice long weekend. Thank you very much, my friend.
Great to
And
be here.
remember, if you want to make money, follow Tom King. And remember, you got to risk it to get the biscuit, baby. Good luck, everyone, and have a happy, safe Labor Day. Thank you, Tom.
See you guys.